Good morning, everybody, and welcome to this episode of Derek Invests. I'm your host, Derek Miller. All right, what are we going to talk about today? As usual, I am always trying to keep it interesting in what we are looking at, and I love to look at a lot of different sectors, industries, markets, you name it, because I like to prove that what I do and what I teach here and the system that I operate under transcends any individual index, any individual commodity, any individual currency, whatever the investment is. And today, what are we going to talk about? Well, it's the first month of trading in September. It's September 3rd, 2024. What is September synonymous for, everyone? Right, market crashes, markets that fall. So I thought that would be a great thing to explore this morning. So what I did was I took a look at what the two best performing sectors were during the month of September. As no shocker to myself and probably no shock to you, it was consumer staples and utilities. Why? Because they are defensive sectors. Now, how many market crashes have taken place in September? I don't know. I didn't do that research. I'm not digging into that. No, actually, ChatGPT could probably answer that very quickly. But the truth is, there's far more fake outs in September than ever seem to be reality. And what I can tell you from watching these markets every day, day in and day out, is we don't have a setup for a market crash. That's for sure. So I don't see that at all, but that is not the point. The point is consumer sentiment, consumer opinion, and market opinion. Because let's face it, most of these market experts are nothing but salesmen or media regurgitators. So that's what they're going to talk about. They're going to talk about how dangerous September can be and the setups they see for the downside. Why are they going to talk about this month? Because they have the highest probability of success in a false forecast this month. It's like remaining a bull, right? If you're a bull, you're right 80% of the time. It doesn't matter that if you stay a bull throughout the bear markets, you make no money, but you're correct 80% of the time. Just like this month, if you bet on a crash in the month of September, you have the greatest odds of success. If you bet on a market reversal in September, you have the greatest odds of success. So that's what everyone's going to talk about. I'm going to tell you that I don't see any evidence of that. But here's an interesting thing that we can do to figure out if there is anything behind that. Is this the month? Right? Okay, so we don't see anything in the indexes. The indexes have weakness, yes, and I've said that to you. And that's commonplace for September. Why do indexes have weakness coming into September? Because it's one of the easiest times to fool retail, to fool investors into believing what is coming? A crash, a big market reversal. So it's not always, a significant portion of the time we come into September with weakness. So there is weakness in the indexes. And the fact that the markets are down today is almost laughable because this is the setup. And this is where the conversation gets to start about the fear mongering of crashes in September when there's no evidence we have anything happening on. I don't see anything in indexes right now that tell me the people in charge of the market, the people that are the foundational structure of the market, have been selling their positions at any high rate of volume at all. And if they're not selling, then there's not going to be a major crash or a major sell-off. Because in 2008, you were led to believe that you couldn't see that crash coming. The fact of the matter is the market was already down 20%. We had been falling since the summer of 2007. We didn't have a crash until September of 2008. That crash was very easy to see coming. The setup for that crash was perfect. We have no setup right now. But what I want to look at is one of the two sectors that I just talked about. So I'll probably look at utilities tomorrow, but let's dig in for ourselves, right? We can't just go on these assumptions that I'm making right now. We don't just want to have an opinion on what we believe is going to happen. We need substance behind it. So I have this belief that a market isn't going to crash. Let's try to disprove me. Let's look at the top 10 consumer staples companies and see if they look like they're set up for a dramatic increase in price. Because if they are, perhaps there is a crash in store, right? I'm giving you my opinion based on what I've seen thus far. But if we take a look at consumer staples today and we take a look at utilities tomorrow, and they look like they are poised for rapid price movement upwards, that could mean that institutions didn't pull their money out. They simply were transitioning it into a defensive sector, the two defensive sectors, right? Well, there's several defensive sectors, but those are the two best performing defensive sectors for September. Therefore, for market crashes, therefore, they're the ones we want to look at. So let's take a look. All right. So what we're going to look at today is consumer staples. We are going to look at Procter and Gamble, Coca-Cola, Pepsi, Nestle, Walmart, Costco. Bu- 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 I can't remember the others. We're going to look at the top 10. All right. So let's get started. We will take a look at Procter & Gamble, Coke, and Pepsi first. Let me share my screen with you. And remember, if we see something that looks like a massive market rise, like these stocks are poised for a big run, that can mean that there is a sector rotation occurring into those defensive sectors because it's September, which could indicate something. So here we see, oh yeah, the Nasdaq's down 1.5% coming into September, not at all odd. Procter and Gamble. Let's take a look. So I don't think hitting all-time highs right now. All right. So Procter and Gamble hitting highs. They're hitting highs in a meaningful way. Let's take a look. We're going to zoom into a weekly. How was everybody's Labor Day weekend? Mine was amazing. You know, I was talking with my wife this weekend about Labor Day weekend and the fact that I know it's a U.S. holiday and that it's not a holiday celebrated around the world. But I have to tell you, to me, these holidays are so important. Because myself, I'm an entrepreneur, right? Okay, guys, we see this rising. There's some massive volume, but it is on the breakout. So you have to imagine that this is all those, machine trading. They jumped in once the breakout existed. You see one back here too. This probably caused the breakout right here. Okay. So this probably caused your breakout. This is definitely institutional players getting involved because the trading activity is standout. This is definitely institutional trading getting involved, and institutions are relying more and more on machine trading and computer trading, which I believe will be the fall of them. I don't believe that's the way to do it, but they're trying to manage. There aren't small money managers anymore. All these guys want to manage $1 trillion in assets, even though it really inhibits what they can do for you. So you're going to see some of this. It's just becoming more and more obvious, which is amazing. So if you're watching me, you're going to learn how to spot this stuff really, really easily. Okay, so here we are. Oh, this is on a price drop. Look at that gap. Talk a lot about gaps on here, folks. If you're not familiar with what gaps are nothing more than if a price closes higher than it opens. So in the overnight, it opens lower, gap fills, it runs up. Gaps are usually used, especially in the downward. If you're at a high, which we are here, and you have a big gap down, traditionally that's used to scare weak hands, retail hands out of the market, so institutions can buy more and drive price higher, which in this case, that appears to be so. Zoom in a little bit more. Procter and Gamble does look strong. Back to the holiday weekend. I don't, I talk during these sessions. You got good volume going today as well. I talk during these sessions. I talk about different things, and the reason I brought up the holiday was because for me, those days like Labor Day, here's a gap it fills, running up on high volume. Those are the days where I really can shut down and not think about work. And I have to tell you, it's one of the things that you have to do as an entrepreneur. I'm sure you have to do it if you're in the 9 to 5 daily grind as well. That's that 9 to 5 daily grind of having a boss and having to be there. I have very limited experience in that world, so I would bet that those days are important to you too. But and it probably ever increasing at this point. Okay, so you have a lot of volume up here at a breakout at a high price. It looks to me like in the next few days, you'll need to return down here to 171. Do I think this is worth noting? I mean, I guess so. I mean, you can always note this if you're a short-term market person, like if you're looking for short-term swings, you're a day trader or a swing trader, I would say you got to come back down here before you continue that rise up. It looks to me to be that way. I'm not going to notate this particular stock because there's just not enough weakness here. So let's move on from Procter and Gamble. As I was saying, even it's probably ever increasing in that world. that you need to take those big mental days where you say I'm not working, because unlike what technology has told us, it has us all working around the clock. It makes us available at all times, and it's so now I imagine in those worlds, you used to work your hours, you went home, you turned your phone off. Weekends came, you turned your phone off, you did what you wanted. I would think that has been changing or has changed. That would be my guess. I don't know. Again, I have limited experience in that world, but it would appear to me that would be the case. And as an entrepreneur, I desperately need those days. So whatever your weekend, whatever your holiday is, wherever you live, whatever country you're in, make sure you take advantage of those days, whether the U.S. market is open or not. We all need those days, and I'm a big advocate for holidays, especially with my family. Let's see if Staples has this same pattern real quickly. Okay, it is on a breakout, so it makes sense that we're seeing a lot of these companies on a breakout. I'm a big advocate with my family and with other families to take the time. Like I made a vegetable tray and a fruit tray for the family yesterday, and we had some steak and hamburgers and hot dogs and hung out by the pool, and everybody came out. We had a squirt gun battle, and I'm a big advocate for that stuff. You have to do those things. I mean, do you need a holiday to do those things? No, but I'll tell you, when everyone is shut down, it really feels okay to shut down. And so, even though it seems to me that the world would love to eliminate these holidays, and probably in the name of the fact that we're moving into a global world, and those holidays sort of create some separation. But you know what? I don't care. I don't view it that way, and I think it's necessary for people. And I think holding on to your culture and holding on to who you are is not a bad thing. I think that's why we all love to travel, right? If we all just wanted to be around people that do the exact same thing as us, I don't know that we need airplanes very much. That's why we all travel. So there's nothing wrong with holding on to those things. And they only separate us if we let them. They can be pretty cool. So with Coke, I don't see a ton here either. Remember, everyone, what we're looking for is high trading activity. Why? Because the strong hands of the market, the institutional hands, use high volume to stamp their footprint. This is how you can identify. Some guy on Reddit isn't doing this. What's his name? Roaring Kitty. I guess he's trying to make a comeback as some sort of advisor. He was the head of one of the biggest pump and dumps I'd ever seen. He cost people more money than I've ever seen. I don't know why any of you are fans of this person. I don't care what he says he's for. What he was for was his pocket. It was very obvious. They want to demonize the Wolf of Wall Street, but we're supposed to celebrate Roaring Kitty. Sorry. And if you like him, oh, well, you're wrong. What he did was wrong. It was the average person that got destroyed in his little pump and dumps. It was the average person that made no money. It was him that made all the money. I don't respect people like that. He took advantage of retail. He took advantage of people that don't know as much as he knows. And is probably because he is more involved than you can imagine. And they were definitely in those particular scams. They made so much money on his back, they don't care. They don't want to catch him. If he can do that again, that's great, because they can outplay him easily. Coca-Cola sort of has the same move as Procter & Gamble, and honestly, there is no big downside here. It's definitely a breakout, but the entire sector is breaking out right now. So we do see a gap here, and as we saw, there was downside on Procter & Gamble as well. So would I say it needs to return here? Yeah. I mean, this is a consumer staple, everybody. Is this a huge move? No, it's 1% below you. So again, if you're a swing trader, probably closer to a day trader, this might interest you. I am not going to, well, you know what? I will take a picture of this one. We'll look at Pepsi next. It does look like there's been some transition into consumer staples, though. It most certainly does, because, I mean, it's breaking a new highs, going against the underlying market, its underlying index, in, relatively substantial ways. If you're breaking a new highs while the index is reversing, that's substantial in itself. Let's move on to Pepsi. Let's see if we can find something. Okay, so Pepsi's interesting. it's a laggard in these staples. And sometimes the reason you want to look at laggards is laggards will catch up to the leaders. Let's see if that appears to be the case here. No, Pepsi does not have a lot going on. Here's some gaps. As you can see, they've filled. Gaps have filled. You got a strong reversal off the high at 182. But with the sector itself looking very strong, I think it would be very reasonable to expect Pepsi to break out of this high. So exceed. You would see this high and you would expect Pepsi to have a breakout. And this does for you swing traders and short-term traders for upside, because you would expect it to be on that level. Also look like weakness in Coke and Pepsi. We didn't look at the staples as a sector. Oof, that's a lot of volume. That's a lot of activity, everybody. That looks like it's going to move. Let's see. Look at that. Look at it approaching that 177. Wow. Look at. I mean, you can see this is a move. You see this? I'm in the wrong place. There we go. I'm telling you now, when you see this on a 5-minute chart, you could expect to move to the high. In this case, because of what I saw in the background, I would expect higher prices. I say you would expect for what is today? 9/3/2024. You would expect right now that Pepsi has a breakout. And you would expect that to break higher than 183. You see, the last two staples didn't show substantial volume right now. Why not? Well, they've made their run. They've been transitioned. This is why when you find a laggard in a leading sector, so you found a lagging stock in the top 10 of a leading sector at the moment, or a historically leading sector. So historically, staples have led the S&P 500 in September, and you found a lagging stock that all of a sudden has a ton of trading activity coming into play right now, and it's lagging the other two companies we looked at, which were Coca-Cola and Procter & Gamble. That is ripe for a move. Let's see, NSRGY, that's Nestle, UL, and Walmart. Okay. Let's go back. Real quickly, everyone. I'm going to start. I had overwhelming demand for my mentorship in August, which got started last week. So I'm going to start another VIP mentorship in 2 weeks. And what I want to tell everyone is I would encourage everyone to have a much stronger focus on my one-on-one coaching sessions. The mentorship is great. Don't get me wrong. It's amazing. It's an amazing 8 weeks. In my opinion, you'll learn more about the real world and finance in those 8 weeks than you've probably learned throughout your life. And definitely if you've only been tuning into the very standard financial information, because that's really there to kind of lead you down the road that you're meant to be led down. And if you haven't noticed in the last 4 years, that road typically is a road to profits for others and not for the individual. So if you have more knowledge and you are the stronger hands in any industry, you are leading folks down the path to profitability for you, which is oftentimes not really the best path for them. So that is the case in this industry also. So what I would tell you is I have a VIP mentorship starting up in 2 weeks, but I would strongly encourage you to consider the one-on-one coaching over the VIP mentorship. I want to do something here. I'm going to put my Twitter handle for those of you that are not following me on Twitter. You should be. I put so much information out on Twitter that it makes no sense not to be. Let me add that there. Okay. My mentorship starts in 2 weeks. dmiller@prometheaninvesting.com is my email address. Please leave your name, number, and email address so that I can get a hold of you and make sure that what you're looking for this mentorship program aligns with. Also, Derek Invests at Derek Invests on Twitter is where you can find a lot more information. I stream my lives there every day. I do on Twitch, Kick, Facebook, Instagram, LinkedIn, YouTube. So I have a lot of stuff going, a lot of social media information. But look, if this stuff interests you, if you can see what I'm talking about makes sense, I have a mentorship starting in 2 weeks. I do limit seats. That is not a joke. I had to turn a few people away last month. So if you are still interested, hit me up this month. dmiller@prometheaninvesting.com. Your name, number, email. Also, leave your time zone or where you're from so I know a time to contact you that makes sense. And then ask about the one-on-one coaching. The one-on-one coaching is if you're serious about investing and if you have serious money in investing, like you are investing yourself, and it's your retirement account or you're young and you want to build this account into something truly meaningful, the one-on-one sessions are the place to be. If you're not following me on Twitter, you'll get a lot of information there at Derek Invest. All right, let's hide that again and let's go back to let's get back to what we're doing. NSRG, which is Nestle, UL Walmart. Okay. NSRGY. There we go. Oh, this is really lagging. In fact, you could take this a little further. This has gone beyond lagging into it is weak within consumer staples. But do you know something interesting that hits me right away when I look at this monthly chart? This right here. Take a look at the trading activity occurring right now. What month did this start? This started in January of this year. The trading activity is at a price that went from 140 to 100. So it's a 40% drop, everybody. And there has just been an increase in volume. Look at the preceding volume. So what you want to look at when I say that there's high volume, remember, it is relative to the preceding volume. This, and I'm going to change the color of this so it's more obvious. This is your preceding volume. Oh, that color doesn't work. What about that one? No, that doesn't work. Let's go with that. That's terrible. Yellow. These colors aren't very bright, are they? Blue? No. Purple? But it's fine. So when you look at the preceding volume, in fact, I'll just throw this, which is way down here. I'm going to make it a red line, even though it's going to disappear in there. We have a ton of volume this year in Nestle. All right. So this interests me because it's after a 40% price drop. This is the stuff you're looking for, folks, when you're looking for buying opportunities. This is a 40% price drop. So let's put that up here. A 40% price drop followed by a massive increase in volume. So traditionally, I'm going to change this arrow and put this one here. So traditionally, this would be buying of institutions because the volume from 2020 until now has been, lackluster at best. It's terrible. And all of a sudden you have a huge pickup in volume right now. So in 2024. So this is of great interest to us. This is something you want to zoom in on and you go, okay, this has, it looks as though it has some very definable risk, which is what we look for. We want definable risk, but we also want definable upside, everybody. You want definable upside too. You don't just want definable downside. right? Does that make sense? If you don't know where something's headed, you can't draw a path to where you believe it's going. And if you can't, look at the volume now. How does it look now, everyone? Look at this volume. That's in 2024. This is not a small time frame. This is all of 2024, okay? This is 2024. Weak in the market. I agree. It has. Well, Derek, you always say, not to buy weakness. Right. I don't want you to buy weakness. Right now, what we're doing is we're not saying this is a buy or not. We're not saying anything. Right now, we're saying this particular position is a position thus far that we would have a high level of interest in. And now we're going to move in to the daily. This is a great learning tool, everybody. You should be here to learn, right? All right, so there's so many gaps on this chart that you really can't pay attention to them in Nestle. Now, why would you say that is? Is it trading volume? I don't know. You have 500,000 shares traded a day, not necessarily. That's not on the high side of volume, obviously, but it's not on the low side. Like, that's all right. There's not a ton of manipulation going on at 500,000 shares at $100, right? There's not a ton of, you're trading 500 million a day. But there are gaps everywhere. Do the gaps appear to fill? Yes, but they're not the best price targets. This volume here is really interesting. Keep zooming in. Look at that. That's got to be 5th, right? The 5th? No, it's August 22nd. Gap down, pulls up. This thing's building energy to the upside. There is no doubt about that. Is there a reasonable downside target? Now, even though there's gaps all over this chart, this thing fills gaps. So right now you're looking at 107. That's only 35 cents below you. That's not even worth taking a look at. Let me come back to 104. I mean, look, this one might be one where you have to give a higher upside target over a longer time frame. I mean, it just is what it is, everyone. It doesn't have, you can say long term, this looks like it is being bought at a very high level. Why, I have no idea. So if you were a long term trader, you could very easily, like safely assume that you're going to have, I'm going to make this blue because that's to the upside. You are going to have, and listen, for those of you that think only short term is the path, well, you don't know a lot about taxes and taxation. When you're building a portfolio, you have to pay attention to your taxes as well. Taxation is very important. So if you're looking, let's do 9/3/2024. We're going to do NSRGY target 143. Because we are in the fall officially, you can say this is a 6 to 12 month move. Because it is a consumer staple, you have to allow a little more time with this thing because staples don't move as quickly. So if you have a 2 to 5 year outlook on this particular company, target state, as I'm talking, I write staples, of course, target date. If you have a 2 to 5 year outlook on this, and I would be fairly certain this would be within 2 years, and it's 40%, folks. This is 40% in the next 2 years. If that to you is it doesn't appeal to you, well, there's going to be an interesting path that will get laid out soon enough as well. But right now, what you can say is if you're a long-term or you're looking for investments to exceed the 12-month capital gains rate because you live in the United States, you just found one that has tremendous upside. It has definable upside, definable downside, which you're sitting at the downside. The downside's $100. The upside's 143. This is a great position. This is most likely a long-term position that I would be interested in, and am interested in, to be quite frank with you. When you're managing your money, you need long-term positions as well as short-term positions. So UL, Walmart, where are we at here? We're at 30 minutes. Okay. I'm sure I still got some hangers here. I know that some of you tune in for the entire show, which I really appreciate. And I appreciate all of you that tune in. And I appreciate all of you that open your mind to the fact that, hey, maybe what I've been told about this isn't exactly accurate. Whoa, this is a very interesting chart as well. Unilever. Look at this. How's this for some volume, everybody? How's this for some volume? Now, the only thing you can say about this volume is you've got to be careful. This volume's taking place on a breakout, on a long breakout, right? Like is this making, I don't know if it's exactly making a new high today, but it's sitting at a new high, which means it's going to get a lot of pushback. I like this though. So this has been building up steam since $52. We're at $64. And how long ago was this? November of 2021. Your low side is 42. It looks like the buying started at low 46, high of 54. So 50, 42. This is where your buying's taking place. And now you're breaking to a new high. You probably can say that 50 is your downside. You're sitting at 64. You're breaking to a new high. Let's wait. Let me get rid of this drawing. Let's zoom in and have a look here. Let's take a look. Weekly, is anything happening at this high? No. So all of that buying that we saw is there's no selling to coincide with that buying, which is probably has an average cost of about 50, right? It has an average cost. So you're up 30% right now on that position, but we don't see selling, not on a weekly chart. Let's move down to a daily. Now there is a really big gap down here. What price did I say, everyone? Did I say 50? That I did. That I did. And believe me when I tell you, I do not go through this stuff before I get on these lives. I don't need to. I have no interest. And here's something. You're down here at 48, everyone. Does that mean it needs to reverse to 48? Well, no. It doesn't mean it needs to. Not now. You're looking at a daily chart, 6 to 12 months. You're on a individual position, Unilever. It trades what? I mean, 2-4 trades a lot of shares, 2 to 4 million a day. I mean, what did it do here? And this isn't. This is here. So you would think this would want to that's just, what it is. Let's zoom in. This looks like there's been a lot of buying going on. Was the way to survive the 2000, 2003 50% market drop. I mean, if you were rotating sectors in 2000, 2003, you barely felt that move. So people that don't believe in sector rotation are fools. There are plenty of bear markets you can point at to show that sector rotation works. Now, there are a lot of bear markets where it did nothing. When you have a massive global economic event like we did in 2008, and I believe that event was caused because strong hands got a little too cocky, drove prices a little too far down. They scared the hell out of retail. They lost control of the market. How rarely is that? How rarely does that happen? I think it's pretty darn rare. And I think that 2008 taught them that greed has its limits. So I don't expect an event like that maybe ever again. Okay, here we go. This is a good short-term price target. We're in on a 30-minute chart. You're looking down at 62, right? You're sitting at almost 65. That's a 5% move. Let's zoom in and see if there's anything right now that would tell us that move is yeah, I mean, there certainly is. See this volume? Look at this. We're on a 15-minute chart. Look at the volume here. Look at the trading activity up here at $65, right? 64, 65. As we know, the market is a business. That business is run by companies. Those companies are the foundation of that business. They have mechanics that they follow that allows for market corrections, big and small, and market recessions, big and small. So those mechanics elicit emotional behaviors because we're human beings. So what we want to know is, what do those mechanics do to the emotional stability of those on the other side of the trade, which is the weaker, less knowledgeable hands, right? AKA retail. And right now, when I see volume like this, I say, well, this is institutional hands at play. It's at a high price. A 5% pullback. We said their average cost is probably 50. You're at 65. That's a 30-some% run. To have a 5% pullback makes perfect sense, which makes this a great price target. We have the volume. We have the reason behind the move. We understand that it is a move based on structure, based on mechanics that a business works within. It's the same thing as like if you own a t-shirt shop and you have one t-shirt that everybody wants, it's reasonable to believe that you would drive up the price of that t-shirt. Now, as demand decreases and you want to sell that t-shirt, what will you have to do? You'll have to drop the price. If demand is decreased and you still want to sell the same amount in volume of that t-shirt, you have to bring prices down. Thereby, you should increase demand again. Because when prices drop, if it was a t-shirt everybody loved, people are going to go buy that t-shirt. Hey, the price of that t-shirt dropped again. We got to get down there and get it, which will drive prices higher again, right? That's the structure of the stock market. So this is very reasonable. Let's zoom into a 5-minute, although I'm going to come back to this chart regardless. So on a 5-minute chart, as you can see, this had to fill. There's a gap at the high that has to fill if they're going to drop at 5%. So that gap has filled. There's no need to talk about this any longer. So what we're going to do is we are going to go back to the 15-minute right here. We are going to, we could put a big smiley face emoji there. Delete that. That was an accident. There we go. There we go. We are at 9/3/2024. We are looking at UL, which is one of the top 10 consumer staples, everybody. We're looking at a price target of 62. We are in the fall. We are on a 15-minute chart. So this should not take more than 2 weeks, which would also justify some of the weakness we saw in general in consumer staples, doesn't it? So if consumer staples is showing general weakness and we take a look at something that looks like it wants to break to new highs and we see that general weakness, so it's the 3rd. So 2 weeks from today is the 17th. 9/17/2000. It shouldn't even take this long. As you know, I am always conservative with my price targets. If you think that's too far out, well, go somewhere else. Just kidding. You should have trades along all time frames. If you are properly managing money, which is comprised of risk management, cash management, and investment management, you should be working along different time frames within your investments. You should not be operating on the same time frames. If you operate along the same time frame, what do? You increase risk. Why? Because if you're wrong, everything gets hit. Reducing risk is key. That's one way you can reduce risk. All of my students that work with me one-on-one completely understand we are always looking for positions that have upside targets and downside targets, and we're working across different time frames as just two pieces to our risk management. Okay, let's take a look at Walmart. Woo, baby. Fair to say that's on a run, huh? Now, did it break out and return? Sort of, because here's your breakout. It returned. There's your breakout and a sort of return. It's getting a parabolic run. So while a lot of people would be in love with this particular position, I don't like stocks that go parabolic. What's parabolic? Up, straight up. We're on a daily chart. I see a gap at 68. Obviously, we're going to explore that. I see a gap down at 61 as well, which is showing some of that weakness we talked about that we saw in general in staples. Let's zoom in on this and see how long it lasts. We're going to look for a near-term target. We're at 1 hour here. What is there? Earnings back there? Of course, there's earnings used to drive the price higher so that institutions have the opportunity to sell off. I don't see, to be fair, I don't see a ton of selling. There's definitely some occurring, but I don't see a ton of it. We're probably not at the place yet where this starts pulling down, but you could start building into your short, and I'll tell you why. This is definitely a target that you should be looking at, a monthly target right here. I'm going to post this because I love this as a monthly target. Sure do. It doesn't appear as though the move has begun, but you should understand how to scale it. You should understand how to scale in and out of positions if you are trading your own investment account. If you're not scaling in and out of positions and you don't understand why you would start scaling into a short at this level, or you don't understand what scaling is, again, one-on-one coaching is definitely for you. Walmart. I don't want to pitch that too hard because the truth is I only want people that want it. I only want people that get it, that say, hey, I can see where I've gone wrong. I can see that this makes sense. I do not look to convince people to do this, right? I look for those that are already searching, and I put the information in front of them that proves I know what I'm doing and I am consistently accurate. And it doesn't matter what I am looking at. Target date. We're going to give this a month. We are looking at a 30-minute chart. I am telling you that it doesn't look like the move has begun because it doesn't. But it may have. But I would start building into my short position now. This is a great short-term move for sure. It's only a month. So this is a great short-term move. Start scaling into that short. You don't always have to be playing options, everyone. You don't always have to be playing futures. This is a big move. From 78 to 69, right? That's call it even if you call it 78 to 69, you have an $8 move. You're looking at 11% move on a stock in a month. If you were to find, one of these once a month and only put 10% of your portfolio in it, meaning all you're risking is whatever downside in that 10%, right? So maybe you're risking 3% of your portfolio, but you're getting 10% moves. That's a guaranteed 12% per year in performance with little to no downside. A lot of ways to run portfolios, folks, and that's why it's so individualized, because that might be you. You say, look, if I'm making 12% with very, very low risk, for me, that's heaven. Well, I don't know why you'd ever look at an option. I don't know why you'd ever look at a future. I don't know why you'd ever look at leverage. You don't need it, right? Let me take a look at time here. I know how I get. I'm at 40. Yeah, I'm at 45 minutes. We're gonna shut it off at Walmart. I'll do some more tomorrow for sure, and I'm also gonna get into utilities. Oh my gosh, I was not screen sharing. I stopped the screen share and I never turned it back on. So you did not see the evaluation of Walmart. I'm going to real quickly pull that up, although most of you, I'm sure, have tuned out due to that blunder. But this happens on lives, everybody. I mean, what do you want me to do? I was live, and so here is your gap if you're still watching on Walmart right there. Okay. Don't need that. Let's do this. Right there's your 69 price target. Why are we looking at this? I'm going to go back and show you right now. Let me remove these two drawings, and then I'll do real quickly. I'm going to go back and do the last stock to Unilever. So why are we looking at Walmart, everybody? Let me go back, because Walmart's gone parabolic. You see this upward move from 52? That's parabolic. That's just straight up, all right? So there has been a move into Walmart for sure. And I know Costco's on this list, and I didn't see it listed, so I'll be taking a look at that tomorrow too. So there you see it going parabolic. Anytime anything goes parabolic, it interests me. And then on a daily chart, we're looking at gaps. You see gaps on a daily chart on something that's gone parabolic and you don't pay attention. That is a big, big mistake, everybody. Let me go back to UL. I'm going to show you again here real quick. Has this gone parabolic? Let me show you. Let me let you decide. Nope, but it's breaking to new highs on high volume. Since 2022, it's been building. Average cost probably around $50. Here you go. We zoom into the week. Daily. I apologize for missing that screen share, everybody. Here's your gap. Here's your gap. There's definitely weakness there, and there's weakness in the underlying sector. Yeah, it happens on lives. I apologize again, everybody. If you're interested, here's my email address. I have a VIP mentorship starting in 2 weeks. It's the best 8-week course you'll ever take in your life in regards to finance and investing. If you ask me, I've never seen anything quite as good as someone who's actually trying to manage their own money. I've never seen any course that dug as deep as I do and taught you how this stuff really works the way that I do, the way that my system works. But I strongly encourage the one-on-one sessions. I think those are where it's really at. That's just my opinion. It's 40 weeks. I mean, it's long term, and you need long term, right? You want to learn how to surf in big surf. You're gonna have to start in small surfs first, but you would better be trading with someone that's done it before. Otherwise, it's going to be a painful journey, and that's what I'm here for, to help make that journey a lot less painful. If you're not following me on Twitter, I am at Derek, DEREK, Invests, INVESTS. If you're not following me, you should be. There's a lot of information that I cover over there. There's a lot of charts I put up over there that I don't on the other channels. If you're watching me on YouTube, LinkedIn, Facebook, Instagram, Kick, Twitch, Daily Motion, it goes out everywhere. So anyway, look, thank you so much for tuning in, everybody. And listen to me. If you're not good up here, you're not good anywhere. If you're having a hard day, remember this: you're batting 1,000. You've never missed. You've never failed. How do I know that? Because you're still here. You're right now watching me, right? So you've never failed. I don't think you're going to fail now, right? But if you're having a hard time, get outside, get in the sun, go for a walk, smile, grin like an idiot, right? Fake it till you make it, everybody. I promise you, you do this for an hour, you'll have no choice but to have lift your mood at least a little bit. You will, right? Hey, thank you all so much for tuning in. Love all you guys. Remember, every day above ground's a good day, and I'll see you all later.